Hello, and welcome to today's webcast, Private Equity Funds Update. Before we begin, I am going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market firm. You can read more about this exciting news on our website, which is linked in your console. And with that, I'm pleased to turn it over to Principal Syed Rizvi to get us started for today. Syed?
Thank you, Laura. Welcome, everyone. This is our 2025 Private Equity Funds Update. We have a pretty jam-packed agenda covering a wide variety of topics impacting private equity funds. So without further ado, let's go ahead and look at our agenda. We'll start off with the private equity funds observation and outlook for the rest of the year in 2026, followed by a state and local tax update. After that, we'll go into our federal tax update, and then we'll finish off our presentation with the valuation under market heightened volatility and uncertainty. With that, welcome to our webcast. My name is Syed. I'm the audit principal in our financial services practice. Without further ado, I will hand it off to Brett to kick us off. Brett.
Thanks, Syed. Hi, everyone. Thanks for joining. My name is Brett Sproul. I'm a director in our transaction services practice. I'm based in Southern California, and I focus on buy-side and sell-side quality of earnings reports and for capital raises, PE firms, VC firms, and private companies. I'm going to be giving an update on private equity observations for 2025 and outlook for 2026. So deal flow and exits are set for an uptick in 2026. After several slower years of exits and tough fundraising, experts and market indications suggest a significant increase in deal-making, exits, and strong performance starting in early 2026. Recent quarters have already shown notable increases in deal flow, especially among middle market sponsors, suggesting growing confidence that economic and interest rate environments will be more favorable going forward. The observation in our own practice here at Baker Tilly has been that deal flow has been hampered by tariff uncertainty and elevated interest rates to start off 2025. In particular, many of our manufacturing and retail deals were put on hold while companies and sponsors evaluated the impact that potential tariffs would have on their bottom line. Now that companies are coming out of that and starting to go to market, we're starting to see creative adjustments to many of our deals to attempt to mitigate the impact that any tariffs may have had on certain sectors. In connection with some of the recent economic uncertainty, we're also seeing much longer hold times for PE-backed assets. In general, a standard PE fund has a lifetime of 10 years, meaning it deploys and returns the total capital LPs have invested by the time it's a decade old. According to recent surveys of LPs, 51% of respondents say they've been waiting more than 13 years for their PE funds to fully liquidate, and 12% say they've been waiting over 15 years. Due to the sluggish traditional exit markets, continuation funds have emerged as a preferred alternative for providing liquidity to limited partners, while allowing general partners to retain exposure to high-performing assets. This approach has preserved the upside for both parties when an outright sale is unattractive. As a resulting consequence of this dynamic, transaction volume in continuation funds reached $41 billion in the first half of 2025, a 60% increase from the previous year, with about 19% of all private equity exits using this mechanism. Having said that, there remains an estimated $3 to $4 trillion in PE-backed companies awaiting exit. The pressure to realize value from these assets will likely accelerate exit activity throughout 2025 and into 2026. In our practice, we've continued to observe increased activity on the sell side as companies prepare to go to market in late 2025 or early 2026, with the expectation that some of these economic uncertainties will subside. PE investments remain concentrated in high-growth, resilient sectors like technology, healthcare, and infrastructure, which together account for over 40% of deal activity. In Southern California, where I'm based, aerospace and defense remains a strong sector, with deal flow remaining consistent throughout 2024, 2025, and no signs of slowing down into 2026. While 2026 is expected to bring renewed optimism, PE firms and M&A activity more broadly will still face uncertainties related to inflation, regulatory changes, AI, offshoring, and talent retention. Despite the improvement in exits and liquidity, fundraising may remain challenging until the backlog clears. However, investor sentiment is positive, and allocations to private equity are expected to increase or remain flat for most limited partners. Another big opportunity that's on the horizon for PE firms is the possible accessibility of private equity to 401k balances. On August 7th, the president signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors. This policy makes it easier for employer-sponsored retirement plans to offer investment options in private equity, as well as other alternative assets like cryptocurrency and real estate. It remains to be seen how successful the order will be in getting employers to provide such 401k options to employees. Private assets tend to be harder to buy and sell than other investments, have longer holding periods, and typically come with higher fees. The private equity sector has long targeted the vast $12 trillion defined contribution retirement market. And while recent changes could open this capital pool, PE firms will also face new challenges, including scrutiny over their suitability for retail investors and the risks of offering such assets to the public. Here we can see the trends of middle market M&A transactions. This is the space that Baker Tilly primarily operates in. And you can see that we're in a downtrend in 2024 as compared to 2021, 2022, 2023. And we expect the cycle to be back on the upswing. So we're optimistic. again, here is PE-specific middle market exit activity. 2025 results so far are consistent with 2024 results, and we're expecting that to continue through 2025 and accelerate into 2026. You can see here, this is the dry powder by fund size. So middle market is lower in the dark blue color. You can see there's a tremendous amount of capital still available that needs to find a home, presumably in the next 12 to 24 months. And so we expect the investments to continue and accelerate through 2026. With that, I think we can move to a polling question.
Great, thank you. Is polling question number 1. Do you anticipate evaluating a potential transaction within the next 12 months, either buying or selling? A, yes. B, no. C, I'm not sure. I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and make sure to hit submit. All right, we'll give everyone a few more moments. And here are the results.
As expected, I think a lot of people on this call are in the M&A space and evaluating potential transactions, so that makes sense to me. We'll turn it over to Josh now for a SALT update.
Thank you. And I want to thank everybody for joining. It looks like we have wonderful attendance today. About 590 joined, which is fantastic. Maybe just by way of background, I'm a state and local tax principal with Heritage Moss Adams, now Baker Tilly, based in San Francisco, and I focus almost exclusively on California consulting and controversy matters. So my disclaimer would be that my presentation is by design California-centric. And in that realm of California, I do lots of planning, audit defense, protests, settlements, alternative apportionment, tax appeals. And I've had the good fortune of arguing and prevailing before our administrative tax court, the Office of Tax Appeals. So all things California-centric, as maybe a headache for people around the country, it is as far as I'm concerned, a full-time job. So today we're going to cover some legislative updates in California from an income tax perspective. Then we're going to turn to the status of California's ongoing market-based sourcing regulation update project. And then we're going to round things out with a little bit of San Francisco gross receipts tax reform. I added that because it is one of the more, if not the most complex city tax in California. So it had a substantial reform last fall as a result of the November election. We're going to cover a little bit of that too. So why don't we jump right into legislative developments. First up, Senate Bill 132. Passed this June. It is an extension of California's pass-through entity tax regime. So in the partnership, multi-member LLC and S-Corp space, the pass-through entity tax regimes are pervasive. Many states have them. It was really just, I'm sure I'm covering old news and familiar territory for folks on this call, but when the Tax Cuts and Jobs Act of 2017 limited the state tax deduction to $10,000, that limitation was only placed upon individuals and not business entities. So many states responded by enacting pass-through entity tax regimes, effectively allowing partners in a partnership or shareholders in an S-Corp to shift the tax on their distributive share to the entity level, thereby making it deductible for federal purposes, even though the tax that they would pay in their individual capacity would be limited to $10,000 of federal deductibility. California's original regime was set to sunset at the end of 2025. And now it's been extended from that sunset through 2026 all the way to 2030. And they'll probably reevaluate as we look at the 2031 tax year. But for now, it's going to be here for 2026 through 2030. And I did want to call out that in addition to extending the pass-through entity tax regime, there's a notable relaxation of California's controversial prepayment requirement. So let's go into a little bit of history here, why this was such a headache for so many, and why this relaxation of the prepayment requirement, I think, is very good news for a lot of folks. So for 2022 through 2025, the California pass-through entity tax regime had a rigid prepayment requirement. So the status of the law before Senate Bill 132 was that on or before June 15th of the tax year at issue, a qualified entity needed to pay the greater of 50% of the preceding year's tax. Because our regime started in 2021, this requirement kicked in for 22. So beginning in 22, you had to pay the greater of 50% of the prior year's pass-through entity tax, or $1,000, whatever was greater. And that needed to be done in order to be qualified to make the election when the return would later be filed. The penalty for failure to meet this requirement was that the entity was disallowed from electing. So, for example, if on June 15th of 2024, you didn't pay the greater of 50% of the 2023 tax, or $1,000, the 2024 year would be forbidden from making that election for that partnership. The 615 timing was always kind of an interesting thing. I've asked folks in legislature what the logic was. Why did they originally do this? And the answer I've always received was it was just a cash flow acceleration play, just to get more money in through the door earlier in the year. So, that was the original intent, but it really served as a hurdle for many unwary taxpayers who missed it. And it created a number of problems, not the least of which is that on June 15th, the prior year's return might not have been filed, or if it's being filed on extension, was very likely to not have been filed. That's one big part. And then the second, really common issue with it was if there was an extraordinary transaction in the prior year, paying 50% of the prior year tax may have no rational relationship to what the current year tax would look like. And this requirement still meant that if you didn't pay 50% of the prior year tax by 6/15 of the current year, you were forbidden from making the election. So lots of problems embedded in this system. It's not going away, but the penalty for missing it is changing. So beginning in 2026, the 615 prepayment requirement is being relaxed such that if it's missed, you aren't disqualified from the election, but there is a 12.5% credit haircut that is incurred. So if you, let's say, underpay it or miss it, the qualified taxpayer's credit against personal income tax, meaning the flow-through pass-through entity tax credit that the partners would claim, it could receive a 12.5% haircut. So there is, call it, a penalty to missing, but it isn't as stiff as not being allowed to make the election altogether. It just takes perhaps an economic piece of the overall federal benefit that might be there by reducing the California credit available to the owners of the pass-through entity. It's something, how they dealt with it, they evaluated a number of different ways, but I think most practitioners are happy to see that the payment requirement is not going to disqualify taxpayers anymore beginning in 2026. There might be a small penalty to missing the June 15th, 26 payment, or 20, if you extend that on, that requirement goes all the way through 2030. But it isn't as rigid or punitive as the old system. And I guess that's a step in the right direction. also wanted to flag that we have Senate Bill 711 sitting in the California Assembly. It hasn't been passed by the Assembly or signed by the governor, but it does propose to change California's federal conformity date from its current status of January 1st, 2015 to January 1st of 2025. So we are a fixed conformity state. Our general conformity date to the IRC is again 2015. And this would change that to 2025. I think there's good and there's bad. It's taken them forever to, a long time, 10 plus years to get an updated conformity date that picks up big pieces of the Tax Cuts and Jobs Act. But at the same time, we just had the One Big Beautiful Bill Act passed and signed into law on July 4th. So I do think it's, disappointing that this conformity date would miss another large federal tax bill. And I jokingly say to colleagues and clients, are we going to be sitting here in 2035 debating whether California is going to conform to pieces of the One Big Beautiful Bill Act? It just takes them so long to pass conformity legislation. It's a shame that it is looking like it's going to pass, but won't pick up the federal changes that were signed into law on July 4th of this year. It's currently sitting with the Assembly. Most are optimistic that it's going to pass, but it hasn't passed and been signed yet, so we are continuing to monitor it. Now for market-based sourcing update. This is, again, I guess the recurring theme is everything takes forever in California. Since 2013, California's had market-based sourcing for sales of other than tangible property. And for about a decade, the regulations for implementing market-based sourcing have been the subject of debate for amendments. We have a rulemaking project that's been going on since 2015 to amend our market-based sourcing regulation. And let's dive right in. So this is the statute that's on the screen. And it basically changed us from a costs of performance state to a market-based sourcing state. Sales of services are attributed to California to the extent the benefit of the service is received in this state. And as noted on the bottom of the slide, our regulation 25136-2 was promulgated by the Franchise Tax Board to serve as guidance for these sourcing rules. And notice I focused on services because of the nature of this audience. I think sales of intangible property also important. That is a source to California to the extent the property is used in state. But the bulk of the amendments that we're going to talk about relate to the sourcing rules for services. And I just wanted to be upfront about that. So where do we sit today? What are the current rules? And then let's go into how they might change if the FTB is able to in the not too distant future, finalize its proposed amendments. So today, our rules for services are bifurcated. The sourcing for receipts from services from an apportionment perspective is based on the type of customer, and there's different rule sets if the customer is an individual versus a business entity. When a customer is an individual, there's a presumption that the billing address is where the benefit of the service is received, unless the customer's contractor books and records show otherwise. And if it's unknown, we would go to the reasonable approximation rules, which is a different cascading rule set than business entities. If the customer is a business entity, we start with the contractor books and records. Then if that doesn't show where the benefit of the service is received, we proceed to reasonable approximation. If reasonable approximation can't be undertaken or there is no known reasonable approximation, then you look to where the customer placed the order. And if that is not known, the final step in the cascading rules would be billing address. So for individual customers, you lead with billing address. And for business entity customers, it's really the last step in the cascading rule set. There are also separate rules for sourcing interest income that parallel those that have existed for a long time for banks and financial corporations. There's separate rules for sourcing receipts from dividends and goodwill. separate rules for licenses of intangible property, and the complexity here is significant, and many taxpayers struggle with the application of market-based sourcing. So let's talk about what the Franchise Tax Board might be doing to change this, or to try to provide guidance. I know it comes from a good place, but I don't know that they're eliminating complexity. They might just be adding more. But let's look at where the FTB is at on the rulemaking project. It's been going on since 2015. There have been, I think, at least 6 interested parties meetings. A notice of proposed rulemaking was posted last fall in September of 2024. A new comment period opened through October 31st of 2024. And the most recent interested parties meeting was in January of this year. And the most recent draft text for the proposed FTB amendments to our market sourcing regulation were released on May 20th of this year. So let's talk about what's in the most recent draft of the FTB's regulation. I think one of the most notable things is it eliminates separate rule sets for individual versus business entity customers. So as I noted before, the current regulation starts with, is your customer an individual or a business entity? The new regulation would scrap that and have a uniform rule set irrespective of the customer type. Those rules, as they relate to services, would now ask what the service predominantly relates to. Is it related to real property, intangible property, tangible property, or individuals? And depending on what the service relates to, this rule set creates they call it simplifying presumption of the sourcing. There's also new rules they're proposing for government service contracts, new rules for large volume professional service providers. Think legal and accounting that have more than 250 customers. Those rule sets for large volume professional service providers, I'll maybe pause there and note that they go to billing address unless a customer represents more than 5% of total receipts, in which case you revert to the simplifying presumptions approach. But if it's less than 5% of receipts and you fall within the large volume service provider rules, it's generally billing address, which might be simplifying in nature. And then last, and perhaps most interesting to this crowd, if we're talking about the PE and asset management space, there's a new sourcing rule set for receipts from asset management services. And let's dive into that because it's probably most relevant for this particular audience. And I guess I would say, if you were on this call last year, this may look familiar because the reg project was going on last year and the proposed asset management sourcing rules have not really changed since that time. They're still proposed, but we're going to go through them again because if this goes final, this will be the rule set for asset management services. Perhaps as a starting point, what do we mean by asset management services? The intent of this regulation is that it means gross receipts from asset management services that are not already subject to 25137-14 are sourcing rules for regulated investment company advisors. So California has had a specific sourcing rule regulation for RIC advisors, those managing investment companies organized under the Investment Company Act of 1940. Those rules have been around since 2007. But if you don't have receipts from RIC management, those rules don't get triggered. So there's been this gap in guidance where, PE, VC, and hedge fund advisors don't have a rule set unless they have $1 or more of receipts from RIC advisory. And that gap in guidance is what the FTB is trying to close. So they're going to mirror the approach that exists for, call it, traditional mutual fund advisors and try and map that onto asset managers like PE, VC, and hedge fund managers. So under the draft regulation, asset management services are sourced based on the domiciles of the investors or the underlying beneficial owners of the assets under management, unless the investor of record is holding title for a different party. I'm thinking of like an omnibus account or a fund of funds where the investor of record might have its own investors. And if that's the case, there is a look-through approach where the benefit of the asset management services needs to consider the ultimate beneficial owner of the assets under management, which I'm well aware can be a very difficult rule to implement in practice. And if the taxpayer doesn't know the complete value of the assets held by beneficial owners in California, the receipts can be assigned to the extent of the average value of assets held by investors that is reasonably approximated or reasonably estimated to be in California. So it does incorporate call it a reasonable approximation approach if it is truly unknown where the underlying beneficial owners are. And there's an example. So let's go through the example. The example of the draft reg. I think it will illustrate that look through and kind of some of the complexity that can arise. So the Asset Management Co. is the management company. It manages a fund, and the fund has two partners. The first, limited partner one, is domiciled in California. So and the fund manager owns 20%, outside investors are 80%. So limited partner one is domiciled in California. Limited partner two is a fund itself or a conduit that has two underlying investors, or it doesn't specify, too much other than limited partner two has one investor that's in California that owns 20% and one investor that owns 60%, where half of its underlying investors are in California and half are not. So we have to do an averaging. So if we look at the fund ownership at the beginning of the year, limited partner one is in California and owns 20%. Limited partner two has half ownership in California and owns 60%. So 20 plus half of 60 is 20 plus 30 equals 50, right? So you have 50% at the beginning of the year is beneficially owned in California. And then at the end of the year, the ownership of limited partner two in California has gone down to zero. So at the end of the year, 20% is owned in California. So your beginning of year and end of year averaging is 50% at the beginning of year, 20% at the end of year. Your average value of California beneficial ownership is 35%, right? 50 plus 20 divided by 2. You're averaging beginning of year and end of year in this example. And I think that's what the next slide says. Yeah. Answer 35%. Sorry, I jumped ahead. But that is a beginning of year and end of year averaging, which, I don't think that's perfect science. I have seen some clients say, well, we fluctuate a lot. That might not be accurate. Should we do monthly averaging? I've gotten that question before. And I do think that it's the one size fits all approach might be difficult, and there could be some flexibility for different averaging that might be a more accurate representation of the amount of assets beneficially owned by California domiciliaries. But that example is incorporated into the regulation to help provide some guidance to what these rules would really look like. So when's this going to go final? The most recent messaging I've heard is the end of the summer, perhaps later this month, early next month. But the Franchise Tax Board has been saying the draft regulation will go final for a long time. This project to amend our market sourcing regulations has been going on over a decade. So I take it with a grain of salt, but I do think that they are intent on wrapping this up soon. I can say that much. And I'm sure when it happens, there will be so much collateral going out from all the professional service firms that everyone will hear about when this goes final. So I'm not worried about it not making its way out there. It'll happen, I'm guessing, this fall would be my best estimation right now. Let's, in the interest of time, turn quickly to San Francisco. The San Francisco gross receipts tax is one of several business taxes that San Francisco imposes. It is a very complex tax regime. And on November 5th, 2024, San Francisco voters passed Measure M, which makes substantial changes to our city's gross receipts tax. It, I think, is generally positive. I think it's been well received by the taxpayer community and the tax practitioner community. It's a tax regime that was well deserving of reform. So let's talk about some of the more notable items that were in Measure M. It reduces the number of business categories from 14 to 7. And those business categories dictate the particular rate structure that your San Francisco gross receipts would be subject to. And for this audience, I think the second bullet point is the most important, that the old system had different ways of determining San Francisco gross receipts. For traditional service providers, it was payroll-based apportionment, where your San Francisco payroll based on hours worked in the city over total payroll everywhere was really the apportionment metric by which receipts would be sourced here. But that wasn't required for all business types. Some used 50% payroll-based sourcing, 50% market-based sourcing, and that really was, I think, beneficial to many technology companies, but traditional service providers and most asset managers did not qualify for that, and we're looking at payroll-based apportionment. So the new regime, it takes a lot of the weight off payroll, and it is a more uniform approach where 25% of San Francisco receipts is determined using an in-city payroll percentage, and 75% of receipts allocated to San Francisco using market-based sourcing principles. So the weight off payroll, I think many San Francisco-based asset managers probably like that. If you're based out of the city or out of the state, but substantially avail yourself of the San Francisco market, it probably puts more weight on a metric that attracts receipts to San Francisco. And I think that's the intent behind this change, that it's trying to shift the tax base and tax burden to businesses based out of the city, but that avail themselves of the San Francisco market. There's also a lower threshold for imposition of our homelessness gross receipts tax. It is call it a special rate increase when you have more than 50 million of taxable gross receipts in the city. The threshold for that imposition is now reduced to 25. So I think generally speaking, this whole regime it's somewhat tax neutral, but not really. It's going to have winners and losers, where you might have fewer receipts sourced to the city, but the rates might be going up, or the imposition of the homelessness gross receipts tax threshold might be going down, triggering it. It also, going to the next bullet, lowers the overpaid executive gross receipts tax rates by 90%. That was a newsworthy tax that if the highest paid executive, the ratio of highest paid executive compensation to median San Francisco-based employee exceeded 100 to 1, there was a special tax rate system that kicked in. They didn't abolish that tax, but they lowered the rates by 90%, which I think was interesting. If you're going to do that, I kind of query why hold on to the regime if you're going to phase it down by 90%, but that's what they chose to do. And there's also now a 9-month filing extension available if 110% of the prior year's tax is paid in on or before the original return due date. I think that's a really welcomed change. The 9-month extension will help a lot of taxpayers get more certainty as to their San Francisco receipts at the time the return is actually due. So I think that's a really welcomed change. Sorry for droning on so long about California. Now we're going to go to our polling question, and you can get nightmares of California out of your head for the rest of the presentation. So So thank you, folks.
All right, thanks so much. Our second polling question, my biggest state and local tax headache is A, state notices and audits, B, federal/state conformity issues, C, pass-through entity tax regimes, D, local/city tax issues. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We do have quite a bit of content to cover today, so most likely we will not have time for questions. So feel free to submit your questions in the Q&A box located on your console. All right, and we'll give everyone a few more moments to respond. And here are the results.
All right, looks pretty split.
Pass it over to Ashley.
All right, thank you, Laura. So my name's Ashley Sievers. I'm a tax senior manager here at Baker Tilly, and I sit in the Spokane, Washington office. So let's talk federal tax update. First things first, the current law. For those of you who don't think taxes are as much fun as I do, here is a snapshot of how the One Big Beautiful Bill Act was passed. So TCJA was enacted in 2017 and was effective from 2018 through 2025. So we have known some sort of tax reform during 2025. The knew they could probably pass tax reform through the budget reconciliation process, and the initial House bill was passed in May. Then after lots of revisions and back and forth, ultimately voted on by the Senate with a 50-50 split. The Vice President cast the final vote, and it was signed into law on July 4th, 2025. I wanted to that would affect funds the most of that bill. So we'll start here with stock or QSBS 1202 stock. The new law made 3 key changes. The first of which is the tiered holding period. So prior to be held for 5 years to get the exemption. Now is a 50% exemption after 3-year holding period, 75% after 4 years, and 100% after 5 years, like it's always been. Note that this is effective for stock purchased after July 4th, 2025. So if you have sales coming up, unfortunately, that does not count. So it will take us about 3 years to see the benefits of this portion of the change. The next change here is the increase in the per issuer limitation. So the per issuer limitation, was the greater of $10 million or 10 times the adjusted basis in the stock. Now the limitation went from that $10 million to $15 million and also will be adjusted for inflation starting in 2026. If we think about holders, they're limited, well, everyone's limited, but to the greater of the two, and now half of that greater of limitation increased. So this could have on the amounts that these small shareholders will get to exclude compared to their basis. There we go. The last change in QSBS is an increase in the gross asset threshold. Under the prior law, the gross assets of the corporation that was invested in could not exceed $50 million at all times prior to issuance and immediately after. So now that $50 million threshold, $5 million, and will be adjusted for inflation. Many more companies are expected to qualify as QSBS due to this $25 million increase. Then as a nice add-on to that, some R&E expensing changes will also affect the gross asset threshold from the last slide. So under TCJA, corporations were required to capitalize R&E expenditures, which would increase their assets. Now that those can be immediately expensed, more and more corporations could stay under that new $75 million threshold. And then just a few other items from the One Big Beautiful Bill Act. This allowed miscellaneous 2% expenses. That disallowance is now permanent. Controlled force, or CFCs, the downward attribution rules were adjusted, could reduce the need for Form 5471 filings. However, the code's fairly sparse and there's a lot of speculation on the rules here, so there will be more to come on that topic. Lastly, and this is more for the management companies, the 99 moved from $600 to $2,000 and will also be indexed for inflation. So hopefully that can help ease some administrative burden. So a couple of thoughts on the One Big Beautiful Bill Act and how it'll affect the portfolio companies. The Section 163J calculation for interest expense, it got a little bit of help starting in 2025, or starting for 2025 tax years. The limit was 30% of earnings before interest and taxes, but now is calculated based on earnings before interest and taxes, depreciation, and amortization. As I already covered a little bit before, but those domestic R&E costs can now be immediately deducted. And then lastly here, 100% bonus depreciation is back for property, for property acquired after January 19th, 2025. Just a quick observation, with this new act, there are several different effective dates. So it's important for you to make sure you're aware of what kicks in when. I also want to note what was not included in the bill, carried interest loophole. You know, this is a hot topic among this group and could have a huge impact. It was discussed by the current administration into a few versions. However, ultimately, it's not discussed at all in the final version. Then the Section 1061 that requires a 3-year holding period for GPs to receive capital gain treatment was just left alone. All right, let's chat briefly about what's going on at the IRS. The reduction in workforce has been in the news, so I wanted to put some context around that. There were about 7,000 probationary employees terminated, and about 6,700 of those were less than 1 year of service, and most were under the age of 40. And as of March 2025, about 54% of the Deferred Recognition Program, or DRP, those approved employees were on administrative leave. You're probably asking yourself, why do I care if they've been there a year or under 40? What we're concerned about with here is the expertise of the agents that are left. So a majority of the probationary employees were under that 1 year of service, but many of the DRP employees were not. So my concern is with the employees that are left. You know, do they know what they're doing? When new employees join their team, can they train them well? You know, what's going to be the outcome there? In terms of the business units that were affected by the reduction in workforce, the revenue agents were affected the most, with about 30% of the reduction coming from revenue agents, and that impacts their critical audits. And then here's a few numbers on the appeals caseloads, and it focused on the last 5 years. So you can see here in the last 5 years, cases received decreased from 85,000 to 52,000. Overall, cases closed peaked at 81,000 in 2023, but then fell to 66,000 in 2024. And pending cases dropped significantly to 33,000 in 2024. Our team here at Baker Tilly that works with the IRS saw that some cases were just dropped overnight. And then others are just sitting stale at this time, and there's no IRS agent to contact about them because there's no longer anyone assigned. So the decline in the volume of the work has a lot to do with the shifting job positions in the IRS as they try to work with the number of agents that they have. Then last topic for me, some case updates. So Sorbonne Capital, we've been talking about this for a while. Quick refresh. The court looked at limited partners and determined the applicability of self-employment tax. Courts have been making a functional analysis test to determine if they are truly limited partners or not. None of that's new information. However, in May 2025, in the Denham Capital case, it's a very similar case, the judge still took an all or nothing approach. So it was this same court, but a different judge. And it was determined that the partners who put in a significant amount of work couldn't be limited partners. And notably, there was not discussion on whether someone could be a service provider as well as an investor. So we're going to see more and more come out related to the same issue. So with that, we'll move to the next polling question.
All right. Thanks so much, Ashley. Polling question number 3, how comfortable do you feel? Sorry for some background. How comfortable do you feel with the One Big Beautiful Bill updates? A, pretty comfortable. B, somewhat uncomfortable. C, hope. So there's more emotions around that, but here's just a few to select from. For those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We will also be sending the slides along with the recording of this event via email after the webcast. All right, and we'll give everyone just a few more moments to respond. And here are the results. And we'll pass it over to Leo.
Great. Good morning, everyone. My name is Leo Miki. I'm a managing director in the Valuations group located in San Francisco. Today, I'm going to cover some of the challenges of valuation in a volatile market or a volatile and uncertainty market. So right now, we're observing a fairly volatile market. There's a lot of macroeconomic uncertainties, factors like inflation concerns, interest rate, tighter credit markets, and geopolitical tensions. All of these, they can influence your valuation assumptions and ultimately your fair value marks. And because of this, we're also seeing greater scrutiny from your investors, LPs, auditors, and regulators. And my hope is through this discussion, you'll be able to take away some useful ideas in terms of how to navigate through your evaluation process. So just a quick recap on the valuation approaches. There are 3 generally accepted approaches. Each of them has its own variation. Income approach, we're often talking about the discounted cash flow analysis. Market approach, you can be looking at trading multiples, transaction multiples, or transaction that involves a subject company, like a round of financing. A cost approach, that's less relevant here, but typically we're looking at replacement or reproduction cost. And once you have estimated the fair value of the business or the equity using one or more of these approaches, the next step is to allocate that to each of the equity class. Common share equivalent or a fully diluted method, that's one. You may also want to run a option pricing model that takes the rights and preference in consideration. A P-warm, it's a probability weighted scenario analysis with different exit scenarios. The current value method that uses a waterfall assuming an immediate sales. And then which one to use, that will depend on the fact and circumstance surrounding each of the particular investment. And then I have listed out the key inputs in terms of valuation, and we'll go through these through this presentation. And then starting with the income approach. So uncertainties, that definitely makes it difficult to come up with a reasonable financial projection. For instance, geopolitical tension that can impact your revenue projection, inflation, tariff, your cost assumptions, and like Ashley was talking about, domestic policies that can change your view on your expected tax rate, depreciation, including bonus depreciations and other tax incentives. And those can also impact your capital investment plan. And market volatility that also impacts your discount rate. That I'll cover on the next slide. But it can also impact your terminal view as well. So uncertainties definitely make it a little bit more challenging to come up with a cash flow projection. And so you may want to consider running different scenarios or sensitivity analyses. If you are already doing that, perhaps maybe consider widening the range a little bit. And the primary benefit of running these analyses, one, it typically allows you to identify the key driver of the value. And then once you have a better understanding of that assumption, that will allow you to think through sort of what the appropriate adjustments is. In addition to that, it does give you more support, and you can document that and communicate that back to your stakeholders. For the discount rate, right now we're in a relatively high interest rate environment. There's a lot of speculations around the timing of the rate change. This adds volatility to the market, and it can impact the risk-free rate or the cost of debt. Higher volatility typically means higher betas. And another point to consider is the time horizon. So if you're extending the cash flow projection, the longer the extended period, the greater the impact of the discount rate. So you may want to take that dynamic in consideration when you're coming up with your discount rate, particularly if you're looking at like a high growth investment. So once you updated your discount rate, and the discount rate, it's making sort of an unexpected movement. Start by identifying sort of the key inputs that's leading to that change. You may want to revisit the source, apply a normalized view versus the spot rate. You can make company-specific adjustments, assuming the circumstance allows for it. And also, like performing a trend analysis, make sure sort of the current rate and the inputs that you're using, it makes relative sense to your selections in prior analyses. And again, if you're making any adjustments, make sure you're documenting the support as well as the rationales. From a market approach perspective, so higher volatility that typically widens your multiple range. You might also see sector-specific movements, like a niche sector that might showing hypergrowth, or another sector being hit like severely hard. So the volatility, it can also make sort of the forward multiples less reliable or disconnected with the current view. And then change in investor sentiments that can also compress the multiples. There might be less transactions out there that you can look at or use as comparable transactions. So if multiples are showing significant shift, make sure that the change is reasonable given the circumstance. If not, you may want to revisit your peer group. Widening the peer group sometimes will eliminate noise in the data set. You can make company-specific adjustments, but if you are, make sure you're comparing the subject investment to the peer group and see if there's a relative financial or performance or operational performance that can justify that adjustment. And again, similar to the discount rate, you might want to look at your historical selections and see if the relative movement makes sense given the market conditions. And if you are relying on the last round of financing to indicate your fair value, make sure the assumptions made at the transaction, those are still relevant, and you're not using outdated or stale data. The shift in investor sentiment, the transaction may not be reflective of today's outlook. And also, if you look at your peer groups, multiples from the transaction date to the measurement date, potentially that might indicate that the transaction may no longer be a reliable indication. So again, if you're relying on the last round of financing, I would suggest sort of revisiting the assumptions made at the transaction, review the conditions and the expectation at that time, and then from there perform a calibration to the measurement date, reflect the current performance as well as the current market condition.
Sorry to interrupt, Leo. We're going to do the last polling question. I'm going to put it on the screen just the last polling question for everyone, and then we will jump back in to wrap up. So polling question number 4. Thanks so much. Who performs your valuation? A, in-house valuation team. B, third-party valuation service provider. C, combination of A and B. D, others. E, and A. All right, thanks everybody for hanging with us. We'll give everyone a few more minutes to get that last, or a few more moments to get that last polling question in. I'm sorry to interrupt you, Leo. Here's the result. All right, and we'll head back to your presentation.
Yep, seems like a good split. Yeah, so I think I was talking about sort of the allocation. Again, here is you can revisit your exit scenario. If there's a change to it, you might want to take that in consideration. And then I know I sort of covered this at a relatively high level, but sort of summarize the points. One, you want to start out with reflecting the macro environment as of the measurement date. From there, calibrate and make sure you're calibrating to the latest market data, make any necessary adjustments specific for the subject investment. Whenever possible, use multiple evaluation approaches, see if each of the indications corroborates each other. Greater use of scenario or sensitivity analysis, I think that's always helpful. It should give you more support. And then if there are like secondary market transactions or something that you can cross-check your conclusions against, that is also sort of a good way to corroborate your value. And then last but not least, make sure you're sort of documenting the assumptions and the rationales, and you're communicating that back to the stakeholders. So yeah, with that, Dylan, if you want to wrap it up.
Yes, thanks, Leo. My name is Dylan Peters. I'm an assurance senior manager in our San Francisco office and the asset management group. I just wanted to wrap up by thanking our presenters, Josh, Brett, Ashley, Leo, and also thank Laura for facilitating today's presentation. We covered a lot of great content in a very short amount of time, but I also wanted to make sure everyone knew about our upcoming Alternative Investment Conference, which is scheduled for December 10th. At 9 p.m. PST. So there will be a save the date going out in the next month or two. Likely you will all receive an invitation to that event because you attended today. And we have a lot of great content there as well. We're going to be doing a little bit of a deeper dive into some of the topics we discussed today, things like state and local tax, one big beautiful bill, qualified small business stock. But we will also have a few other sessions. We have a keynote speaker, Dennis Kelleher from Better Markets. He's the founder and president of that not-for-profit in Washington, D.C. 2 panel discussions covering things related to the exciting developments and investment opportunities in the aerospace and defense sector, and also the hot topic, artificial intelligence and how it's impacting the investment space and also the accounting and finance space as well. And then lastly, we'll also have a regulatory update with Emily Abate, who's a managing director at Iron Road Partners and a former SEC examiner. So lots of exciting things to come. Wanted to extend that invite to everyone so that you can put some time on your calendar for December 10th. Otherwise, I want to thank you for being here with us today, and I will pass it off to Laura to finish up with a few housekeeping items. Thank you.
All right. Thanks so much, Dylan, and thank you everyone for a great presentation today. If you submitted a question, we will do our best to follow up with you after the webcast, and feel free to reach out to any of our presenters if you have any additional questions. We invite you to visit our website for more resources and information on this topic, many of which are linked in your handouts window. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. Finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone. And thank you for the additional minutes. Have a great day.